Good evening, everybody, and welcome to another edition of Live Market Analysis. It is a pleasure to join you on a Monday evening to talk markets, and there's been quite a bit of action around the place. Hopefully, some good action. I mean, there's plenty of shorts out there doing their thing. There's still a couple of, or a few decent longs out there as well. But I think hopefully the portfolio management model has been has really shone out for you as being the most valuable part of everything we do here on Monday nights. Obviously, we're going to talk about that and a whole lot more after we talk about the disclaimer, which says that everything we're going to discuss this evening is general in nature. It has not taken into account your personal financial circumstances, objectives, or particular needs. So before acting upon any of this general information, you should consider it carefully or seek the help of a financial professional to determine its appropriateness for you. The other part, of course, is that trading is risky at some stage. You will lose money. That is inevitable. It's how you deal with those losses that I guess is the most important thing, and the other important thing is that you don't blame me because you're responsible for everything that you do. Let us talk about the nature of tonight's presentation. You'll ask questions. I'll give you my best technical analysis reader. Probably talk a little bit about the macroeconomics and the risk associated with some of the stuff going on tonight. If you're going to ask about a specific stock or commodity or crypto or whatever it might be, give you the ticker, the market in which it trades, if that's appropriate, the type of setup. Is it a continuation setup, a turnaround setup, or an aggressive setup? Are we adding risk, maintaining an existing risk position? Always helps me if you say, hey, I'm already in it. You know, I mean, what do I do? That rather than I might be buying or I might be selling, and what key levels are you watching if you know them? Let us head over to the AMI broker screen while you are collating those requests. I'll do the portfolio management model, which, based upon Friday's candle, I believe puts us at a 1/3 risk position maximum for our US share exposure. If you don't have any US share exposure, that's a little bit irrelevant, isn't it? But if you do, then my model, you can do whatever you want. My model requires me to have not more than 1/3 of the capital I've allocated to this particular market invested. And that could be longs and shorts, and that means 67% is in cash. That's a very high cash weighting. We've talked about why such a low exposure rating, because they are longs and shorts. Other people might think, hey, you know, the market's going down. It's obvious. You know, things are going to get worse. You better short the hell out of it. And I say, well, you can short the hell out of it up to your 1/3 risk level, because markets go down. I get it, and they can go down quickly, but they tend to be really volatile when they do, compared to our ability to go full risk position, because let's face it, the capitalist system facilitates bull markets more often than not. But if we look at I don't do US scans anymore. I haven't done for a few years now, just time and what I prefer to be doing just right now in my life. I'm not saying I won't get back to it at some stage. And hopefully some AI built tools will help me achieve that in a more efficient manner. But just looking at the Australian perspective, we looking at since the top of the market. So this is the point I want to make tonight, is that from this candle here and including that candle, so going forward for these candles here, just looking at ASX, ChartWatch ASX scans, so they're the scans I publish for you. Well, I give you the watch list. Nobody else gets the watch list, so you guys guys and girls get the watch list every night. But in those watch lists and in the ASX scans, which come out the next day, it's been for every one long that's come up in my scans, there have been 5 shorts. 1 long for 5 shorts. So when we think about, well, what does that 1/3 exposure mean? What is the composition of that 1/3 exposure? That's exactly what it is. It can't be any better or any worse when you think about it. If you're getting 5 longs for every short, then it makes sense that that's roughly what your exposure is going to be, very, very naturally anyway. Of course, if you're only trading long, then that 1/3 is all long, and I think that's a bit risky, dare I say, a bit silly. We don't want to go all short either, because there's some stuff that are going up. I mean, there's been some great trades in the energy sector. But just to underline the point, that closed beneath the long-term trend ribbon. We were previously half-assed, so 50% cash, 50% invested, and even that 50% would have had, again, some shorts in it. Now 1/3 officially. Moving over to, you guys and girls know this, but look, this one was very similar. That was the reciprocal tariff debacle, also caused by you know who. Yes, there was still some decent falls from there, you know, but 10%-ish, a bit more actually, wasn't it? So maybe 10 or 15% from when we closed beneath that long-term ribbon. Worth being out of. That one, look how good the long-term trend ribbon is. There. This one we actually closed beneath. You know, that would have been a false alarm. Okay, but you would have got it back in fairly quickly. Notice there was no confirmation. This didn't transition to the long-term downtrend like the other one did because we didn't get that trough set beneath the long-term uptrend. These are all very, very clinical downtrends here. And if we look at this one here from that, we're just talking about the first close. Oh, there's the first close there. What happened after that? So we don't muck around. We don't mess with closes beneath the long-term trend ribbon after a bull phase. That's COVID. Now, arguably, this would have been substantially worse. Can we all agree? You don't have to do thumbs up emojis, but if not for some historic intervention, coordinated intervention, both on the fiscal and monetary side, in that period, this would not have happened. I mean, this would have been, I would say, potentially even worse than the GFC, but, regulators figured out that we couldn't possibly let that happen. So this was an artificially strong one, or an artificially short bear market. But even then, from first close beneath, there was still substantial downside. From 8 to 6 doesn't sound like much, but in percentage terms, it's substantial. And I don't need to prove any points to you because you are already converted. There's a false alarm, so we're up to 2 false alarms now. So the last 3 or 4 bear markets, we've got a couple of false alarms, granted. And there's that one there. What was that? I think that was a Trump one. That was a Trump v China, wasn't it? Pretty sure. And we're going back and just looking at how magnificent this beast is, and going back and back and back. And look, hey, when it's wobbly, it's wobbly. We get that. And there are no signals really for us there. There's that one there. There's that one there, another falsie. Didn't take very long to get back above, though. No close beneath to really confirm the bear market switch. And there's one there. So we're not seeing, I guess we're seeing more valid signals than false signals. My point is, and we can go back to the big one. There's the big one there. My point is that we don't want to trifle. Okay, let's head over here where we already are. And having said all of that, there's a false signal there on the ASX 200, so it seems more reliable than the Nasdaq. But we are officially 1/3 here. We have been 1/3, I think. I want to say, was it since there? I'm pretty sure. Correct me if I'm wrong, but it would have been that candle. You know what I'm like. We've got a close beneath the long-term trend ribbon. We just talked about it, and a peak in the ribbon as well. That would have been the day I would have had no choice but to go to 1/3. And I think on this day here we went to a half, rather annoyingly a day late from contemplating on this day. But bottom line is, a substantial amount of capital, I think, preserved as a result of these movements or these ideas that we have about portfolio management. Nothing needs to be done after today's candle, but today's candle is encouraging. I mentioned it in tonight's evening wrap. There was some demand that came in, and look, a decent little whack of demand that actually came in today, and not a lot of motivated supply side engagement after the morning. So that's somewhat encouraging, but it's still a train wreck. We know that. Okay. We have these Monday nights, we come together as a community, we talk about markets, and we do the whipper and the grounds. And, we have seen this deterioration, this coordinated deterioration, mainly after the end of February when, who did what. And look, I'm not saying what he's doing is right or wrong. That's irrelevant to me. I'm not even debating that. It's not part of this process. The process is whatever's happening is causing prices to move, right? So I'm not saying he didn't do it for a valid reason, nor am I saying that he did. But we are seeing the strongest market prior to that rolling hard, now beneath the long-term trend ribbon. This one was also giving us some strong signals as well that maybe the Nasdaq turned out to be the better benchmark, which is why I've used it all these years. For over 20 years, I've been using it as my benchmark. If you've been following me long enough to know that, you'll know that. And there we go. The S&P 500 has rolled as well. We're seeing coordinated movement here as well, just checking mid-caps out of interest. And volatility, no doubt, is edging higher, but not that high, really. In France, oh man, they had a tough go, much like us. They were pushing to record highs, and the turn has been absolutely severe. culminating in what is Friday is just a clear-cut short and now new bona fide bear market. That confirmation at the long-term trend ribbon is bear market in France, bear market in Germany. I mean, these are brilliant charts. If we're looking for short side turnaround setups, these are pristine, perfect shorting opportunities here. Euro Stoxx 50 looking the same, and in the UK not as bad, but again an unfortunate, and Spain was looking good too, an unfortunate set of circumstances. We're gone there, gonski on the Hang Seng. The Nikkei is still hanging in there, much like the other two strong ones. Nifty's gone, but that went earlier. And in China, we've got some big issues as well. So, yeah, this is telling us that what's consistent with everything we've said up to this point. We haven't picked or analysed a single stock, ladies and gentlemen. Things could get substantially worse from here. Now, either you have done the work and you have demonstrated the discipline up to this point to follow the model, and you're very happy and not worried at all by anything I've just said. In fact, you're actually quite excited at the prospect of seeing what a bear market is like. You're risk appropriate and everything's good, or you haven't followed anything I've said and you are absolutely pooping yourself. And yeah, I don't know how to bring the two together, I guess. Hang out on Mondays. You can either come here as a spectator or come here as a participant. That's up to you. Discretionary sector not looking so good, but interesting day today. To be fair, why did that go? I know AP Eagers is going up because I do have my work colleague Paddy, who he's a great guy, and he where is it? Where am I going? I'm going here. So I want to show you tell you what my good friend Paddy did. On Thursday, so that would be Thursday, Friday. No, Wednesday he made an inquiry about a Tesla. On Thursday he went to view the Tesla, and he took his kids along, and the kids said, Dad, we have to buy this car, in which case he signed the papers on Thursday afternoon and then picked it up on Friday to have over the weekend. So that is an example of what is happening out there in AP Automotive Eagers Automotive land, ladies and gentlemen. Used to be called AP Eagers. So yes, maybe that's why that got a bit of a boost today, because I would say showrooms around the country are full of people looking to buy EVs all of a sudden. Who would have thunk it? But I digress, because I was talking about the fact that the consumer discretionary sector was up today. Did anybody listen? Can I see a thumbs up? You're going to out yourself here. Did anybody purchase an EV last week? Can I see a show of thumbs ups? Any paddies out there? No, just only thumbs downs. But you could imagine what's happening. Energy sector going the other way. Who would have thunk it? And I've said this to you many times, ladies and gentlemen, that even in the worst bear markets, quoting myself here, even in the worst bear markets, there's always a group of stocks that are poised to take advantage, and that is exactly what we're seeing here. Financials still hanging on. Can I wager that when this chart goes, that's when the old tin pot is cactus, and that's what I guess we can keep an eye on. That's cactus. And I know we don't analyse indices, we analyse individual stocks, but if we were analysing indices, not a day, not a candle to do much on this one here. I don't think that's our exit signal. I don't think that's our exit signal. I don't think that's our exit signal, but on this day we must act. Like on this day, following my system, we have absolutely no choice but to manage our risk. It's irresponsible to continue to run at full risk position after that candle. I put to you that a minimum minus 1/3 RP on that day is compulsory, but because they stack, I would say that the addition of not just the candles, but the blended candles together, the closing beneath the short-term trend ribbon, the short-term trend ribbon actually turning amber on that day. And I wonder if it closed beneath a point of demand as well. And I reckon if it didn't on that day, and let's say it didn't, then certainly on this day here, we are compelled, not maybe, not could be, not, well, what if it bounces? It's just, well, that is the model signalling to us that we just are not allowed to have any more risk on this theme. And don't forget, this was a narrative, ladies and gentlemen, that captured the imagination of millions, tens of millions of investors around the world who would have swore to you, black and blue, that on this day here, gold was going to infinity and nothing less. Because, and let me quote them, it is a fantastic hedge against risk. It's a hedge against inflation. Have you heard that one, ladies and gentlemen, that gold is a hedge against inflation? And because of all of those simmering geopolitical tensions, you should be lining up around the block at Martin Place to buy gold. And where are those narratives now, ladies and gentlemen? They are in the darned toilet. And this is why we don't trade on narratives. We trade on candlesticks, price action, and trends. Healthcare, because we're doing the whip around the grounds, that's why we're here. Still bloody awful. Technology, I'm going to say still bloody awful, as much as there are so many quote-unquote experts that I tell you to consult in my disclaimer who are telling you that there's cheap stuff right in there as we speak. And materials got the same treatment as gold, and we had to be quick. Yes, we had to be quick, but we had to manage our risk. Property, cactus, staples, of course. There you go. One of the few sectors again that my daughter's got an economics exam tomorrow. She's in year 11, and at the moment we're doing inelasticity of demand. So we're talking about industries that have very inelastic demand, and supermarkets is one of those. Utilities is another one of those where the demand is fairly inelastic. And who would have thought, ladies and gentlemen, that year 11 economics would have some value even here on the big stage of the stock market? But yet it does, of course it does. But how quickly we forget these things. Let us have a look at the base metals. They obviously have some issues now because, well, I'm not sure if we were having rampaging economic growth before this last little hiccup. But certainly, you know, war is good for commodities up to a point, and different wars are good as well. But wars, I guess, that all of a sudden trigger massive spikes in energy prices, which then can crimp global growth and raise interest rates, can be a bit of a tailwind also. And I think that's what we're seeing here. So, but iron ore moves the beat of its own drum, because this is China-centric. This isn't world-centric, I guess. So that doesn't have to be a surprise either. And everything else is coming off a bit. And just coming down to earth, I guess. Lithium carbonate. I actually think that I got pretty close. I think on my last predictive drawings, didn't I? I don't think I'm all that far away. Let's go to the candlestick chart here. I'll go auto. Yeah, I don't think I'm that far away. It could still happen. Rather stuck in the middle, I think. It's strong day to day, impressive day to day, but we've just lost all volume here. So I guess you can get these moves on low volume where there's just not a lot of demand or supply. A bit of demand supply can therefore move the price one way or the other. Happy to be neutral on that one. That's all we're going to get from this platform. Let's head over to the AMI Broker screen, and we're going to kick off with actually we'll just go back for 1 second just for completeness. We do also have down here Australian spodumene, which looks much like the base metals, and that's no surprise. And then the rare earths, so neodymium, praseodymium, has broken through that short-term trend ribbon as well, just to keep you appraised. We will head over to look at the silver chart first, where we mentioned, and I wonder how many market commentators discussed with you on this day here the concept of the species-ending event, and just with one candle, literally one data point, said to you very firmly that is the cycle high. Like, that's it, ladies and gentlemen. The show is over. And we are learning now the value of the species-ending event and what it does to the market's psychology, which is basically sets this level as an impenetrable barrier, because it created so much latent supply up there that we could not ever hope to get back above it for another 40 years. And that's where we are right now. Anyway, who's to say that call is correct? In the fullness of time, I guess at some stage it won't be, but it is for now. Gold fooled me, I must admit, and whilst we weren't sure at the time, because we said things like hasn't broken beneath the short-term trend ribbon. So that's a positive. And then got itself back above it very quickly. That's a positive. Maintained the short-term trend ribbon for a period of time and actually looked half decent there to break out. We weren't so sure on this one, but now I can say that it is looking very much like a cycle high there also, unfortunately. And it is an example, and a painful but also wonderful example of how quickly markets can change and why we must be nimble, and we cannot wait for things like a 4 ATR stop or moving averages to go all the way and crossover and things like that. What we have, ladies and gentlemen, that so few people, unfortunately, in the world understand to be the most valuable thing in all of investing is price action. And it starts with the candles, it then expands to the peaks and troughs, and then if you're so inclined, you can use some trend ribbons like mine to help pull it all together. We talked about iron ore being very strong because it is a China-centric market. China is 99% of this market, and therefore China is not Iran, so it doesn't matter. Uranium is coming off, which is unusual, isn't it? You actually expect to see uranium rise, as it did when we had the last energy crisis back here in 2022. I want to say actually before that. Yeah, there you go. So that's the invasion of Ukraine, and there was some, obviously that shut Russia out of the energy equation. The world had to readjust. A little bit harder, I think, for the world to readjust to this one, a little bit. Not that the world cannot readjust. You'd be surprised what the world's capable of, ladies and gentlemen, especially when dollars and cents are involved. It's a pretty big incentive. Dollars and cents are important, but then there's also the will to remain in power, and often that is more powerful than dollars and cents. Brent Crude, what's going to skip a few things and go to Brent Crude? Oh, I have not seen that. That is new. That has happened in the last few hours. So if I go to the hourly chart, well, in fact, it's not happened in the last few hours. It's happened in the last few minutes, ladies and gentlemen. Let's go to ladies and gentlemen, this is happening now. So if somebody can Google what the flip just happened and let me know, or punch unmute on your thing and whisper it in my ear. But something is going on as we speak. Such is the nature of the beast at the moment. So there you go. And I was about to say, edging higher, looking very strong. Low downside volatility, and there you go, there's volatility right there. Coal price still looks pretty solid, but anything can happen. Anything can happen. Let's go. United States and Iran held productive talks. It's just been announced, says Jared. Okay, so United States and Iran have held productive talks. And this is the stupidity, ladies and gentlemen, that we're seeing right now, exacerbated by leverage, exacerbated, I put to you, by tick-freaking-tock. Anyway, US futures were down about 1.5%, and all of a sudden, so this is the old print, minus 266, and there you go, there's a new print. This hasn't even had time to update yet, but that has. If I go refresh, we're going to see, there you go, Trump asserts positive. Honestly, because this idiot says it was positive, the world responds. So that, we just saw it down 263, now it's up 500. Okay, on the whim of this individual who has not said anything with any truth to it for about the last 8 years that I'm counting. There was 4 years in between, wasn't there? So let's go for 12, and then beyond that as well, but he was not in public office at the time. So this is what we're dealing with. I think we should probably stop doing the whip around the grounds, because what's the bloody point? And maybe we could say, what's the bloody point of doing any of this tonight also, and adjourn there and just have our evenings off. What do you reckon? Okay, let's check the bond market while we're at it. Let's go bond market. Better check the bond. Let's see what the bond market's doing. Right, the price of money. Now, before we do, let's think about how this impacts bonds, because bond yields have been rising on this in rising inflation expectations. I'll show you an important chart on how you can chart inflation expectations, and you might be surprised to know that if you've got my watch list, which I'm pretty sure you do have my watch list, you could have been charting this for a very long time. But let's think about what's happening with bonds. So yes, rising inflation expectations situations, interest rates are probably going to go higher. So if you've got a bond paying X yield now, it's not going to look very attractive when all these new fancy bonds come out with better yields. So that your bond price falls. And as your bond price falls, for the next person, the next shopper for your bonds, it raises the yield for them. And so everything ends up working the same. The market yields are kind of maintained for new bonds and old bonds, but old bonds have to move based upon what the new bonds will be issued at. So if we think that you'll get better yields down the track, then the price of bonds are falling, right? So people are selling bonds. We know people are selling stocks. We know people are selling commodities. So what are they buying? Ladies and gentlemen, they ain't buying anything. They're sticking it in cash. They're sticking it under the mattress, and they're sitting on that cash, on that mattress, on the cash with a shotgun, because that is what smart money does in situations like this. They go to 1/3 exposure, they go to 2/3 cash. Who would have thought that the market is thinking a little bit like I am? Or the smart money, let's say that. Let's go to bond yield. So we'll start with the Aussie 2s, which, oh my gosh, it nearly got to 5%. So this is the short-term rate. This is pretty much what the RBA is doing over the next year or two. And then we go to 10s. They nearly got to 5.20 today, which is devastating stuff for the stock market and for consumers as well, because we will feel the pinch at some stage. But not 5s, so I want to go 10s. So you can see exactly what I was saying. So before we came to the charts, we said we'll expect bond prices to be going up on those risk-frees because of this chart here, and the 5s are even more substantial. So in the shorter term, in the long term, we know that oil will flow through the Strait of Hormuz. We know that. Oil prices will come down, inflation will get back into check. So that's gone from all of 225 to 238, 13 basis points higher. But in the short term, some shit's going to hit the fan, let's face it. So we've gone from 220 to 265 there on our 5-year inflation expectations. So this is what's driving ultimately this, which is driving the stock market, which is driving your P&L. And that's all I have to say to you about that. I think that's what Forrest Gump said, didn't he? Call me Forrest. That's the whip around the grounds. Let me know that was worth your while. Hopefully it was. Let's go to your requests. You're good, thank you. And yes, probably should package that up and send it out, isn't it? Because that's the sort of stuff we should be hearing as investors. Let's go to Mick, who's got OMA. Then we're going to go to the auto. Last time we looked at it, we had that candle and only that candle, and we said equals R. We've had literally 5 candles in between because we catch up every 5 candles. That day there, I'm questioning whether you want to stay equals R. That day there, maybe that's a minus R. If you could be bothered, if you're happy to give it a go, also very happy to give it a go. So for me, what would I do on that day? Let me just see what it looks like on that day, because I don't want to see what's happening next. No, I think I'm giving it another go on that day. Yeah, I'm not far away, but on that day. So on that day, I can't give it any more. On that day, I can give it another day. On this day, I'm thinking, you know what, life's too hard. So let me go minus R on this day. And, I'm only taking a little bit off the table. I've still got a decent position here. Why have I got a decent position? Because everything else is fine, right? And then we go there. I'm not going to do anything that day. I know many of you would go, screw that, Carl. This is not working out. Clearly, it's not demand side control. It's not FOMO, Carl. There's no FOMO there. There's no HOFU anymore. It's changed for whatever reason. Now, you would have thought that with a name like Omega Oil and Gas, and this is probably what Mick was thinking as well when he bought it, because the chart looked fantastic, I get it. And I put to you, it's probably the only energy stock that didn't actually go up. But Mick was probably thinking, well, this one should go. There's a bloody crisis in the Middle East. And this is the day we're going, see, I'm glad I didn't take so much action. I've still got 2/3. Am I going to add something back here? I don't think so. No, not with this and this here. There's a bit of supply in the system. It's active. It's motivated. We can certainly see that here. Let me just play it cool like Fonzie. Let me see it close at 64 and above, and then I can add that risk back, and we didn't get it, and that's where we are today. These little areas here, there's a bit of demand there. I don't think so. I think this is the one, and I think we can actually keep this very simple from here. So we're minus R. I could probably do, not probably, I shouldn't talk in probablys. You don't want probably, you want what I would do. And to be fair, I can't do anything until I see the candle. So that candle hasn't happened, so in my defence. But yes, I would say close less than there is another minus R. Depending on the candle, they stack and add, and then obviously we have not far beneath that the short-term trend ribbon, which would likely get another little minus R for me there. So regrettable, Mick unfortunately hasn't done, I've got this a little bit of an eyelash or something there, sorry. Regrettable, it hasn't done what we'd hoped it to do, but them's the breaks. Could have been a lot worse. Could have been gold stock, I guess. But hopefully you've also noticed that there have been several gold stocks that have been coming up in the short scans. I'm just trying to think. In fact, Northern Star came up quite early, so at 22-ish there, and a few others that are not coming to my brain right now. I think that's one there. BTR, there you go. So there were a few there. GGP. You would have seen these in the scans. So, you could have got a little bit of hedge. If you were long gold stocks, you probably could have hedged it out with a few opposite ones. Duratec is in the list today, and I'm pretty sure that I put it in the feature list. And now I'm looking at it, I'm thinking, I don't know. Look, it looks good. Don't get me wrong. It's a very strong chart, but it's just a lot of overlap here. So whether it should be feature or just a regular line, I did put it in as a regular line because there weren't that many to choose from. So that's probably it. Now, let me go to the weekly chart, make myself feel better about it. There you go. That's probably what I did is go to the weekly chart and say, well, okay, well, you can't not put it in now. It has to be feature now, even though it loses. Instead of it being 10 out of 10, it's going to be 9 out of 10 because there's a bit of wobbly stuff here. Now that I've said that, yes, there's some wobbly stuff because I don't know if you've noticed that the market has crapped itself. So actually, yes, it's okay for a stock to have a bit of wobbly stuff, isn't it? Because the market crapped itself. So no, that is absolutely fine with me. So Mick's questioned minus 1/3 on OMA. Yes, I do believe that is the case up to this point. Not far from 2/3, and I've given you a bead on the final third. Duratec, he's asked plus 1/3, and I agree with that. So we will go plus R here, or equals R if you've already got it and you don't feel like adding any extra risk. And he has asked about Telix for a potential aggressive entry. We actually discussed this on Wednesday in the regular Chart Watch Live that I'm doing now for Market Index viewers or readers. And I think that's the day, Mick, that it was an aggressive setup, probably that day there, because I think we would have been able to make our 1-to-1 reward to risk at that point. And if it took some squinting, I could allow it, because we don't know things are going to stop exactly at the long-term trend ribbon. And we don't have to be too fancy or finicky about these things. But if we say that this arrow here represents our potential upside from our entry point, and this arrow here represents our downside from our entry point to our first stop level, then I put to you that the green arrow is larger than the red arrow, and therefore we have greater than 1-to-1 reward to risk available into the long-term trend ribbon, where we would expect to see some dynamic supply kick in. Okay, maybe, we expect it. It doesn't have to, but that's why we need to make 1-to-1. So I would put to you that certainly this candle here, and why that candle, because it has met the provisions for the aggressive setup prior to that point, in that we did have, prior to that point, rising peaks and rising troughs confirmed. We did have a short-term uptrend ribbon. Actually, we didn't have a short-term uptrend ribbon on that one, did we? But we did have, I would put to you, sufficient evidence that the short-term trend ribbon has changed from offering dynamic supply, which it did a very good job at, to offering dynamic demand, literally on that candle. That's our dig right there. Okay, so I'm going to go check on that one, price action check. I'm going to go short-term trend ribbon, check. And we would say, did we get a nice price action, volume, volatility signal at the low to mark the end of the selling? A washout of the short exposure, the demand side potentially coming in. Did we get some volume on the demand push? Yeah, look, there's more than enough evidence there to qualify Telix for an aggressive setup on this day here, AGG, and even on this day here, and you could have added risk on the first day. Could have added risk on this one, and you could have added to that risk on that second signal. But today, it's very hard to make the case for it because this candle here I put to you is not strong enough. It hasn't closed sufficiently at its high. Don't get me wrong, it's a good candle, but not as good as this one, not as good as this one. We've got a little bit of supply here that we need to contend with. Not the end of the world, but something that should shape our opinion on this. And we clearly, not going to have enough reward to risk heading into, even if we got in above today's candle's high, to go beneath, say, the last trough, which is miles away, in fact, all the way down here. So is it an aggressive setup? For me, well, I guess the aggressive setup is one thing, and then the reward to risk overlays something else. So yes, it is, I guess, in the realms of being an aggressive setup, but is it an aggressive setup that I personally would take? The answer is no, because I cannot make my reward to risk work. And some of you out there might say, blow that, Carl, Telix is a great company, who cares about your long-term trend ribbon? And there'd be other people listening tonight that would laugh at those people. Okay, let's go to your online requests. And we're going to do George, who's saying, I shorted gold as an aggressive setup based upon the risk reward, but it's now approached long-term trend ribbon. Like, George, you're a genius. Like, what a great segue to go from that to this next chart where we can actually look at the aggressive setup. Because aggressive setups work for short. We have talked about this. Often I put to you that you can do aggressive setups for short. So let's head back here and see how and if it's set up. So was it an aggressive setup? And yes, so we're looking for all the same stuff. And I think we have a very similar ding. I just don't see the candle for it, George. So, and that's not to say, well, it wouldn't have met my criteria. That's what I'm saying. Not to say you shouldn't have done it. It just didn't meet my criteria. And it's unfortunate because it turned out to be right, but it didn't meet the criteria. Let's go actually to this one here, the path tool, and we'll draw in our peaks and troughs, where we go outside here. So that's nothing, inside. So this is all a continuous move to here. This is inside, that's still downside, inside, outside, upside. So we must have a trough somewhere, so it'll be the lowest of those two. And then we go here, and I do believe there's a little dink in here. And then we come down to the live candle. So if we look at the price action, and this is the first bar here that I could contemplate it for an aggressive setup. I wonder if silver, I think George was probably the better one, surely. We'll look at that as well. But this is the candle here that is catching my attention because it's the one after the dink, right? So the short-term trend ribbon, as we saw in the last example, is the short-term trend ribbon crossed in pink? No, it's not. But has it turned and transitioned to behaving as dynamic supply from dynamic demand? I mean, did a bloody perfect, perfect job of behaving as supply as demand, and then this confirmation didn't happen here, right? But it happened here. Like this was, it turns out, will be a species in the event, but we didn't get the trough, sorry, the peak beneath the ribbon. And look at that, this tiny little dink, there it is, and that's the one that worked. But this candle is not emphatic enough to the downside for me to want to aggressively short it. So no, I wouldn't have done it. But let's say that candle didn't have that lower shadow. Let's say that candle was just that black bit and only that black bit, then it changes everything. We would say, yep, perfect demand, supply side control. And then we would need to make this bit, this distance, more than that distance. And clearly it is. And then we'd almost be able to go up there if we wanted to, but I don't think we need to. Yes, it was very, very close to being an aggressive setup. And the question now is, well, we're in the long-term trend ribbon. Lo and behold, like who would have thunk it, the long-term trend ribbon is now perfect, like absolute freaking perfection. Can't make this stuff up. The long-term trend ribbon is where the demand has come back in. Who would have thought it? And this is why we don't mess with the long-term trend ribbon. This is why the aggressive setup requires us to have that one-to-one. So when we get an exit signal here, there's a pretty good chance that we're going to make some money. Or if it pops back up pretty quickly, our worst-case scenario is hopefully closer to break-even than it is to a loss. So there's some reasons why we do stuff. If George is asking, what do we do with this candle? Well, I can't comment on this candle because it's not closed yet. I can't say that the demand side has come in to take control until I see the end of the candle. We won't know that until I think it works on 4 o'clock New York time. Don't quote me, but might be 5 o'clock. It's somewhere around then. Is the changeover. Okay, so we've got a few people reporting in. Thank you for that, telling me what's happening. The S&P ASX 200 is up 200 points, the old tin pot. Hi, Kyle. Your view on T&E for an aggressive setup? Well, there you go. Some people are not worried about markets coming down. They're looking to buy. They're bargain hunting. They're out there buying the bargains. And I get it. I'm not complaining about this one at all because, yes, it has got all the hallmarks of the aggressive setup. We may well make it work into there. So we've certainly had rising peaks and rising troughs prior to this point. There is a little bit of a pullback, but I don't know if you've noticed the market's been crap. And there's a little ding in here, but I actually still think rising peaks and rising troughs, funnily enough. And that is impressive. To be fair, that's impressive. That's impressive. I can't, kudos. Credit where credit's due. Due. Now, did we have a bit of a volatility event on the low? Yes, we did. Has the short-term trend ribbon changed? Yes, it has. Has the short-term trend ribbon gone from being a perfect, immaculate place of dynamic supply to now a perfect, immaculate place of dynamic demand? Yes, it has. Surprise, surprise. And we have this level here, and we've got this level here, and we've got, let's just go the short-term trend ribbon. We've got the benefit of this monster candle. This is one almighty candle today on a crappy day for the ASX. Again, kudos to you, T&E. So that is a demand-side signal. It doesn't always have to be a trough. Troughs are great, don't get me wrong. Troughs make me feel better about things. But this is still a valid signal, and it is still valid to say that if we trade beneath the low of today's candle, something is wrong, and therefore we want to manage our risk. But the short-term trend ribbon is so close, you might as well use that one, isn't it, in working out your distance. But it does become important which one you pick, because if we pick that one, then we can see, well, that's my downside and that's my upside, and I can't make it work. Well, and this is valid. This is not invalid as long as you have something you can pin it to, ladies and gentlemen, because we're not making it a moving target if there's a valid reason there, and we still need to get enough distance. I'd say at least 1%. You can't say 2 pips or something like that because it's a $25 stock, $2 stock. So let's say at least 1% of the share price beneath that low. If it closes beneath that, then we can say unequivocally that the demand has been consumed there. If it gets 2 cents below, has the demand really been consumed? You know what I mean? So that's why I always give it a little bit of leeway. And now the now the arrows start to be a bit close together, but they're still not 1-to-1. So for me, the answer is no. Is it an aggressive setup? Yes, this is an aggressive setup. It must be an aggressive setup because it's not a turnaround setup, is it, ladies and gentlemen? And it's not a continuation setup, but it is a setup, so therefore it's an aggressive setup. Is it an aggressive setup that meets the reward to risk criteria? No, it's not. And therefore, I wouldn't take it because I'm afraid of the long-term trend ribbon, and you all know why. But Sonia, if you're not afraid of the long-term trend ribbon, then knock your pretty little socks off. And that's it, isn't it? That's what it comes down to. This is like, there's no boxing glove. Like, Sonia, if you go to your broking platform and implement this long trade here, because there's lots of reasons to do it, and one reason not to, a boxing glove does not spring out of your keyboard and punch you in the eye. It's not going to happen. That's the good news. However, can I see a show of thumbs up if anybody would like me to implement that system when they don't follow the model? How would, like, the Capilingua boxing glove that jumps out of your keyboard and punches you in the eye when you're about to go against the model? I reckon I could make some money on that one instrument right there. Okay, let's go to 17th of March. It says George. Oh, well, I'm curious. Where's your entry there, George? I could make a lot of money doing that. Let's go back to here. George is saying he got in on the 17th of March, which is the actual Dink day. which is a little bit brave because it's the dink day, but maybe he's looking at the closed, second close beneath the short-term trend ribbon. Two little shadows into the ribbon. I think it's a bit out there, but like I said, it wouldn't have taken much after that. The next candle, any black low close, would have happily had a crack at it just for shits and giggles. But I wonder if silver had the better trade, and not really. I mean, these aren't clear candles here either, so possibly not. All right, let's keep moving to AL3 for an aggressive turnaround setup. The third of the day, we don't really get them, do we, the old aggressives? And it depends what the market's doing. We've got 3 in a row today. Is this an aggressive setup? Well, we know the rules, so let's just go through the rules. Do we have rising peaks and rising troughs? Well, that's the trough, that's the peak, and there is a trough, but it's not confirmed because this is not a higher high and higher low, but it's an almighty demand side candle. So again, not being too pedantic about things, but the price action is so damn sketchy. This is hard work, right? I mean, how do you draw price action on something that doesn't actually have price? Let's face it, it doesn't really have price action, does it? So it's hard to apply my rules, and you can see this is a stock where it's very hard to do that. So I'll go tick, and you can hear from the tone of my voice that this one's a bit tenuous compared to the other two very, very valid ones that we saw. The short-term trend ribbon, it's changed colour. It's gone from an area of perfect, it doesn't have to be perfect, but an area of, it just happens to be, doesn't it? Perfect supply side control of the price to demand side control of the price. It's like freaking clockwork, isn't it? Decent candle. Yes, price volume volatility, all at the low, but even better, we're actually closing above the short-term trend ribbon. So it's not yet a turnaround setup because we still would like to see this sort of business at the long-term trend ribbon. So yes, it is an aggressive setup, but it has the benefit of closing above the long-term trend ribbon. And what that means is that it's no longer an impediment. So the reward to risk changes. So we look up, but you might think, we look up and we see nothing. No, we still see something that should shape my decision-making process, my calculation of what my potential reward is compared to my potential risk. And certainly we've got some price action here that would suggest that we can, we may well encounter, we can expect some excess supply in and around here, right? So we'll call it latent supply in this area. So if our entry is, even if you were to get in at the same price at close today, not that you necessarily will tomorrow, but even if you were to get in here, I think you know where I'm going with this, and our first minus R is there. Clearly, we're not going to make one-to-one into that level. If you say, Carl, I don't care about that level, then go for it. You don't need to ask me. Let's go to AMP. Is this an aggressive setup? Holy shit. Okay. No, I don't think so. In fact, I can say unequivocally no. This is still very much a minus R situation. So and again, we're just applying the rules, and hopefully we're now getting the hang of the aggressive setup. But we should also, before we ask the question, Michael, we should check these things, and we should go, well, Carl's taught me the rules. He said that it needs to be rising peaks and rising troughs. Do I have that? And the answer is no. So that is exactly what we've got so far. So I don't even need to check. I don't even need to talk about the fact that we haven't done the right thing with the trend ribbon yet. Not even close. We haven't really had it. In fact, we haven't had any interesting volume or volatility to suggest to me that the short coverers have come in and the big positional buyers have come in. So unequivocally, this is a definite, not an aggressive long setup. It is still continuation for short. And we should be able to classify every chart into the spectrum, isn't it, of continuation short to aggressive long to turnaround long to continuation long to aggressive short to turnaround short. There is a spectrum. Okay. Oh my gosh. That was Michael. Now this is Kazia. ARU for an aggressive setup. This is a world Monday night record. And this is also not an aggressive setup because this is actually continuation setup, Kazia. So we're not seeing the price beneath the short-term trend ribbon. We've got a long-term trend ribbon. We don't have a long-term downtrend ribbon. We've got a long-term uptrend ribbon. So no, this is a continuation for a long setup. And we should also do the same sorts of things. Do we have rising peaks and rising troughs? I think if you squint, we do, but there's quite a bit of overlap. Short-term uptrend ribbons, but supporting the price, I believe it is. Long-term trend ribbon is supporting the price, I believe it is. Nice volume here, lots of interest. Supply removal into this point of supply, sort of reflected here. There's lots of good stuff happening here, and relative strength, comparative, very, very strong. So I think, yes, this is a valid continuation setup to go long. I wouldn't have any objections if you were in it to maintaining risk on it. Would I buy it? Not on today's candle. I actually would have bought it on yesterday's candle because I think that's a strong enough signal. It's an immensely strong signal where it was. But after today's candle, if you haven't bought it already, then I would just cool my heels a little bit and just say, well, let's just wait for the plus R for the next demand side candle. So if you're wondering, I did put this in a couple of times. I'm pretty sure I did put it in as a regular. I didn't go feature, because as you can see, it doesn't deserve feature. But I'm pretty sure I put it in as regular, just plus R's on those 2 days. Okay. No, Michael is saying AMP for an aggressive short now. He's changed his tune. We'll give him the benefit of the doubt. Well, it doesn't have to be an aggressive short. It's a continuation short, isn't it? But no, we can't do it based on today's candle is all demand. What I want to short something that's showing all demand. Now, if I saw a black candle similar size to this one at the short-term trend ribbon, I'll be all over it. Absolutely, but not based upon today's demand side showing an otherwise pretty crappy market as well. So that's impressive there for AMP. That is the bottom of the list. So let us head over. Oh, no, we've got a few more popped in. We'll do these last ones for Haraju, and then if there are any, in fact, there are no US ones. So last call then. We'll just say last call. Our usual US traders are not here today. Hopefully it's because they have managed their risk and they've gone on holidays rather than the alternative, the grisly alternative. So let's go to DTR. Which I think looks very good. And we've been tracking this for a little while. It's been plus R a couple of times here. Although on this day, I wholeheartedly would have dusted, not just a third, I probably would have dusted 2/3 on that day and kept the third. Back in on this day, very annoyed. Back in on this day, adding risk on this day and adding risk on today. Today is another very, very strong candle. Not a huge amount of volume there, but maybe because, it's kind of got rid of the supply and now it's just back to the regular demand. It could have been a bit better, but still above average. But looks pretty solid to me. Everything else is checking out in terms of the trends. So it's a yes, no objections. If you are that way inclined, if you're looking to add risk, then I think you could do a lot worse than this one. We don't need that anymore. In fact, put that back because we could repurpose it and put it up there. And I think you'll find quite easily we'll make the required reward to risk on that one. And just for your reference, it actually did make feature. I might as well do the rest of the features here. And I'll steal your thunder again, Haraju, because you can see down the bottom of the list is Yancoal. We'll zoom all. It's not what I wanted to do. Zoom normal. And we can see, don't need that one anymore, APA. Amplia, I think worth a go. A cheeky little bit of risk on here. I know anything could happen, but that's a pretty strong signal. And it's just immense volume. So want to have a little bit of skin in that game. DTR, Duratec, we've just discussed. Karoon, looking very, very solid. I don't know what's going to happen to it tomorrow now that, or this one, with the recent events. And World Harmony, it seems. And Whitehaven, we've seen some energy stocks in here. And this is, again, much like where you can get concentrated in gold stocks and think you're diversified, you can get concentrated in energy and think you're diversified, you're not. So always just be mindful of overlapping risk there. But those charts, for what they're worth, what we could see today, without an understanding of the volatility that's inevitably out there, they looked very, very strong. So yes, for me on your YAL Haraju. Okay, we do have one US one. We'll do 40X, and then we're going to, where is Corella? says Robert. He's in Kerala. Let's go to 4DX, yes, and then we will head over to the US. It's 4DX. I didn't put it in today. It did not get 1/3 and it did not get feature. The last time it did get 1/3 was here. It didn't close beneath the point where I put to you was ZRP. So that's good. And this is strong, but neither of them are plus R's for me because I view this as being too risky while we haven't consumed enough of that supply. And they're very strong, don't get me wrong. They in and of themselves, they're extremely strong candles, particularly that one. And yet, even on Friday, this didn't make it in. And a few of you might have been wondering, why did Carl not put that in on Friday? Because I'm worried about this. I want to be confident that the supply that was there is consumed, and I'm still waiting for that confidence. Very close. I'd say close above, we'll close at 450 or higher, white candle, and 100% it'll be back in the list, but just closing shy of that today. All right. Oh, it's in India, says Robert. How about that? Okay, fantastic. I hope you're having fun wherever you are. Let us quickly finish off the single and solitary US stock that we have, IRDM, and hasn't shown up. Try that again. IRDM, Iridium Communications. This one is for, lost it, Jared. Let's double click there, get everything back to normal. Yeah, it's a little bit iffy because we've got the old Vegemite sandwich followed by an ice cream sandwich. So that is indecision max. And I'm working on as I said, I've got some AI, with the help of AI, working on some stuff now. But I'm doing some work into this idea of, I call it friction. And it's stuff I've taught you. So when you hear about, I'm not going to be able to draw it here, am I? Maybe I'll head back to my AMI broker and draw it there. But if you could imagine, two candles, and even they can be white, it doesn't matter. You change that. In fact, we'll do this, it'll make sense in a second. That's not what I want. It'll make sense in a second, I promise. Let's do that. In fact, I'm not going to do that twice. I'll just copy and paste that one. And there we go. So what I say is, so these candles have a great deal of friction. They're both up days. But if we were in a prevailing uptrend up to that point, they've got a lot of friction, right? This is one of several things I'm looking at, but lots of friction. Not much friction. Okay, lots of friction. Not much friction. So, and then there are peaks and troughs, and there's various levels, and it can get quite complex. But my point is that when we head over here, there is a substantial amount of friction here. Friction is just indecision that the prevailing trend should continue. So on that basis, look, it's a bit of a pass from me. Having said that, big white candle that closes above the zone of friction, I could happily look at it. I'd be making sure I have one-to-one reward risk in that area there, which I don't think is going to be a problem. Otherwise, everything else does check out. And in what has been a crappy market, it is relatively strong. So that's a positive as well. But there's enough here to just keep me on the sidelines. All right, I'll go for literally 60 more seconds because just for my own curiosity, AMZN, I just want to have a look at some of the big US stocks and see how they're looking. Bit of a forward-looking thing for us. Are they breaking down? What ramifications might they have? MSFT, for example, look, that's a horrific chart. I mean, that is very much downtrend. TSLA, old Paddy's helping them along, still breaking down. Funnily enough, isn't it? You would have thought they'd get a bit of a kick along here. NVDA, that's not the right. Oh, that is the right one. Holding, and it's been one of the few that have held well, haven't they? Wow, look at that. That's been very strong, coming off a little there. Let's go Goog. Not terrible, not a train wreck. Double APL. Under a little bit of pressure. What about this one? Old school. Walmart breaking down. We looked at Coca-Cola, didn't we, last week? What about some of the banks like JP Morgan? They are rolling. Citigroup holding steady. Not a train wreck, not a complete train wreck, is it? So there is a path out of it, I guess. All right, we could meander through markets all evening, but I'm sure we all have better things to do with our time. So let us adjourn. And as the sign says there, keep calm and follow the trend. I guess when there's no trend, that means something too, doesn't it? We get out of town. Ladies and gentlemen, hopefully you enjoyed this evening's discussion. We'll be back next Monday for another instalment. All the best if you're trading and investing. Until then, bye-bye for now.